Krishnakumar is joining us today, veteran fund manager. Krishna, thank you very much for joining us. What do you make of this one-day scare in the small cap, mid cap, and things got stabilized? You've been a mid cap, small cap navigator for a very long time. Are you booking profits in your position or your clients, or are you continuing to hold on to positions but perhaps have gotten a little more selective now?
Yeah, I think over the last 6 months, the markets have kind of had a good run, particularly in the mid and small cap space and the lower end of market cap, micro cap as we call it. So the space broadly has a tremendous move up in valuation. So one has to be relatively careful at this point and quite cautious. So we have to be, quite stock specific in terms of what we buy. A lot of sectors look good because of the long-term India growth story and what's been happening over the last few years. But however, we need to be very, very careful about valuations and go for more relative value and try to avoid momentum in ideas that we are buying. So we have to be positive but very cautious. Cautiously optimistic is the word to use at this point in time for the mid and small caps.
Krishna, where are you hunting for value? Which pockets of the market do you see risk reward very juicy even from here on?
I think, a Contra style of approach to investing now would be quite useful for investors. Look at sectors which probably have not participated in the up over the last 1-2 years. For example, today consumer durables, many of the stocks have been probably down 30-40% from the peaks that had in 2022 post-COVID. So I think we will see a lot of value emerging there, relatively speaking, from a long-term perspective, given that India is more a consumption story in the long term, and we've had several rounds of price increases by these players, and so the margins also coming back. We're getting the festive season. We'll have probably a better consumer outlook in the next quarter or two, which should be the inflection point. So, given relatively cheaper valuations, we should be looking at those kind of stocks, basically. Also, if you look, on the textile space, the cotton spinning space, you've seen that there's been a lot of value destruction that's happened with the falling cotton prices. So now there's a lot of improvement in spreads, and we see outlook improving slowly, given that demand globally will improve, on a measured pace. But the inventory system is behind us, and we should be getting good traction going forward. So on and so forth. You look at various sectors we have lost one, like auto, ancillary, engineering, etc. There are companies who have been affected because of a specific company event, for example, where they've had some technology issues, etc. Coming back from it. So you should look at those kind of stock-specific sectors. Sorry.
For consumer durables, even the media sector is buzzing, especially the print side, DB Corp, Jagran Prakashan, etc., are buzzing very strongly in trade on expectation that consumer durable will start putting out a lot of ads because of festive season demand comes up. 5 state elections also lined up. This is also a very under-owned area of the market. Would you take a look here?
Yeah, I think 2 things working out for them. One is paper prices were shooting through the roof last year, have been kind of coming down and stabilized a little bit more. The second is they have taken price hikes on the subscription. Third is, as we run into elections also, right? A lot of government releases that happen on the media, on the print media. So we're going to see a lot of action on the government side on the pre-election year, basically. And fourth, I think the under-ownership and the cheap valuations provide good support for investors in the space. Not only the print, but if you look at even some of the satellite cable TV companies, you've seen that many of them have weathered through the OTT storm and have retained market share. There's some consolidation that's been going on, and many of the companies have also reasonably good balance sheets, basically, at this point in time. If you look at companies down south, there have been dominant players on the cable. I think we still have a lot of valuation upside that is possible, in even the cable and satellite space.
KK, Saturn Credit put out very strong commentary today, a 25 plus kind of a loan growth coming in. Some of the other 5-star recently hiked their guidance. some of the other lenders who look at MSME, be it small finance banks or the likes of say Poonawalla or even you grow. You like this kind of a the lender universe?
I think what's happening is the entire grid system has been cleaned out. All the provisioning of the old era has been done with, and we're getting into a new investment cycle. Broadly speaking, we are having expansion in different sectors because the companies are operating at 75 to 80% on average, and some of them are at 90%. So the vendor chain, the ancillary chain, is all gearing up for expansion, given the robust outlook from a domestic perspective. So that is definitely helping a lot of optimism along the NBFCs, the small finance banks, and the SME financing companies, where there's a lot of action. So, given that there is a fair amount of demand for credit and the penetration levels are increasing, a lot of these companies are going to be at the forefront of growth, basically. Well, banks will grow at 12, 15, 16%. The smaller companies will be able to grow at about 25 to 30% for a couple of years and also improve, the margin, given that there's a demand for credit at the lower end of the pyramid.
What about the IT space? IT has also kind of erased all the losses of this year, and now deal visibility seems to be picking up. Would you buy any mid-cap IT, small-cap IT name, or stick to large caps?
I think the valuations and small and mid caps in the IT space have been generally higher, the premium to the large cap base. So one would probably look to buy large cap companies at better valuations relative to their own growth, and also the fact that they can handle all competitive intensity and also technology changes like ChatGPT, AI, etc. I think a lot of changes are happening in the way the delivery of IT is done, and we are seeing a lot of investments going into artificial intelligence and MI. For example, one of the Bay Area fund managers was telling me that a $7 billion check has gone into AI in the Bay Area in the last 6 months. So that tells you a lot of change in technology, and the larger companies will be far better positioned to take advantage of these changes and invest for growth in that area. So I would like to be more invested in large cap IT, but at slightly better valuations. Given that the growth is kind of a little slow, we could probably wait for some corrections to get in there.
One last word, I want to talk to you about the auto ancillary space. Today, Maruti has given a guidance that in the next 7-8 years, they see the passenger vehicle car market double. In fact, they are going to invest 45,000 crore in that. I want to talk about the auto ancillary space in regard with the kind of OEM demand which comes up. What kind of part of the value chain in the auto ancillary space which do you like?
So I think, as we discussed last time around, EV is an opportunity. It is not a threat because India is going to be a country where you have multi-fuel, multi-engine and multi-drivers in the system. So, while we do take cognizance of that, but if an investor is kind of worried about the EV threat, there are a lot of components in the automobile which are kind of agnostic to EV or diesel or petrol, right? For example, look at from wheels to braking systems to vehicle interiors, sensors, air conditioning, and other stuff, which are going to be quite operative in both kinds of vehicles. So we should focus on those kind of companies where there is no perceived threat to the business, basically. And the idea to kind of focus would be also where you have a lot of export market which is opening up for Indians. Given that people are moving away from China, I think there's a lot of shift happening there. So a company, which is basically having a good OEM presence across EV or non-EV and having a significant export market would be something that we should look forward to. Of course, a good replacement market would be also an added advantage for a company. These are the three ingredients that one should look forward when look at auto ancillaries across the space.
Right. All right, KK, we'll let you go on that one. Thanks so much for joining us on the show. That was Krishnakumar of Lion Hill Capital.